So there's a great deal of data out this morning. In fact, I think all of it was substantially better than anticipated. First initial jobless claims plunged to 218,000. Street was looking for 235,000. You can see that chart down sharply from 2 weeks ago. Durable goods also came in above consensus, and it was just not just a headline. That was 2.9%. The core was up 0.4. The Street thought it would be down. Non-defense, which is pure business investment, up big, 0.6%. Then we had the third revision to a second quarter GDP. Normally, this is a non-event, but 3.8% versus 3.3%, absolutely huge. And you can see right there that demand, that real final demand. Many think that's your true GDP number. Initially reported at 1.2, now 2.9. And listen, I think we got to rethink GDP as the ultimate measure of the economy. This is a doozy. So having said all of this, right, you say on one hand, okay, looks like the consumer is doing extraordinarily well. But let's face it, the consumer is not just the consumer. There's real life, and in real time, things don't look as great as some of these numbers. For instance, your number one declining stock in the entire S&P, getting annihilated today, is CarMax, down 25%. It's not even close. This after the company produced quarterly results. They missed revenue, they missed earnings, and this is what really scared a lot of folks. Loan loss provisions are now up 26%. Remember, auto loan debt is now the number one debt in this country. Forget about mortgages. It's more than student debt, and it's become a ticking time bomb. Existing home sales missed consensus. However, the devil's always in the details, right? At sales of $1 million plus homes, you can see that column on your far right or left on your screen. $1 million homes are soaring, right? But anything 500,000 and lower, struggling. So Wall Street takes all of the data, aggregate data, and they see one thing. Main Street, though, they live the nuance, more specific data. So on that note, the Street is worried about inflation and whether the Fed should reconsider cutting rates. I want to bring in now Leuthold Group, their CIO, Doug Ramsey. And Doug, there's more than just one economy, more than just one consumer. What's your assessment of the health of this economy?
Well, it is a two-tier economy driven by asset markets, I think. You did see a slowdown earlier this spring after that nearly 20% decline. I think it was 18.9 in the S&P. You did see a slowdown in consumer spending and retail sales. Well, now that's picked back up, and you talked about the strength in this morning's reports. Good lesson that when the economic data diverge from the action of the stock market, at least consider that the stock market is anticipating things. And then, more importantly, I think in this cycle, like never before, stock market strength is playing a role in economic outcomes. That's always been true. The Fed has always used the wealth transmission mechanism as part of monetary policy. They've been more and more forthright about that. But now it's just the stock market is so much larger relative to the economy that it's ever been. That effect has been exacerbated. And it is propping up the economy, no question.
Yeah, and the wealth effect is interesting because it's a lot more stock market now than housing. So yields have gone up since the FOMC decision. Of course, we have to point out they declined sharply ahead of the announcement. What do you, the focus, should the Fed be focused more on inflation, more on labor? Where should they be in your mind?
They certainly have cover with some of the weak labor market statistics. I mean, year over year, non-farm payrolls up only 0.8%. A stat we've cited now in the last few months is that the cumulative number of unemployed workers is up almost 25% from its cycle low 30 months ago. So a lot of people have been on the sidelines looking for work for quite a while. But I think with regards to inflation, I mean, building on comments I made earlier, the Fed may underestimate the extent to which asset price inflation is spilling into consumer prices. And it's not often that happens. We see tremendous equity market gains in the past, but typically a gain of the magnitude we've had over the last 3 years, and it's 85% now on the S&P 500, not uncommon in stock market history, but generally those happen coming out of a recession low. When unemployment is elevated, there's a lot of slack in the economy, so it doesn't produce inflation. I mean, what you want to remember when this bull market started 3 years ago, unemployment was just 3.5%. And the market cap as a percentage of GDP at the low was still pretty high. It was 135%. Just as a refresher, that's only 10 points below where it was at the tech bubble peak in 2000. So my point is, we began this upswing at full employment and with stocks already quite richly valued, and then you have an 85% rip to the upside in the S&P 500. There's no chance that some of that doesn't end up in consumer prices. Now, the positive side as regards inflation is that perhaps rather than being, this building long-term inflationary undertow that a lot of people think we've seen, it may be something that is more easily extinguished by a downturn in stock prices. So it's rare that rising stock prices are inflationary. They have been in this cycle, but falling stock prices, even a garden variety cyclical bear market of like 25%, I think would be enough to extinguish most of these inflationary pressures.
Listen, I got less than a minute to go, but what if we don't get that? I mean, it's again, you have a lot of folks now on the fence. They've done extraordinarily well. They turn on financial TV, and everyone's kind of telling them to bail out right now. A few guests have said stay the course, but it creates something of a dilemma.
For sure it does. I don't think the Fed's going to get anywhere close to guiding inflation down to 2% as long as the bull market remains intact. There's just too much of that wealth spilling into high-end consumer prices, and then it sort of trickles down. So, yeah, it is a conundrum, but I guess my point is a lot of people think we've embarked on this era of much higher baseline inflation, and I'm not so convinced because of this asset market support that we've had.
Yeah, well, it remains to be seen. But to your point, more people are saying, hey, maybe the Fed should kind of have a range, right? And the Fed themselves sound like they put 2% on pause for a little bit. Maybe they're rethinking the whole thing. Doug, always great work, my man. Thank you very much. Appreciate it.